The third week of quarantine. I hope everyone is doing well, staying safe and healthy, at the same time not going too stir crazy. In that time, of course, a lot of things have happened in the market arena, and we want to take a look about what that means, especially in relation to the markets have come to a very short-term imbalance phase. So what does that mean? And we'll look at that from an overall index review from the S&P 500. Look at some longer-term mounting pressures, kind of from more of an investment standpoint. And then we'll switch back to the short term and see how we can profit and extract value from the market on more of a day trading basis. All right, so let's get to it. So let's go to the charts first, and here we are. We're on the SPX. This is the cash index for the S&P 500. As you remember from last week, we talked about several key resistance points, and we talked about this 21 EMA right here. We talked about the technical support and resistance here at 26.58, and we talked about this overall trends line. And you can see that trend line and these confluence of factors were very powerful, and they held, and the market definitely dropped down. And so basically, price was rejected at this level, but when it was rejected, it didn't come down here and then kind of continue to drop. What happened is that it came very much into this 3-day in phase consolidation, and it's really trapped between the trend line here, right? It's trapped between the 8 EMA, and it's trapped between the longer term. This is the trend line from 2009 all the way up to present day. So right now we have this consolidation where basically price is in balance, right? Price is an advertising mechanism. It's trying to engage traders either to buy or sell. But at this point in time, the market needs more information before it can make a new determination to figure out what that price is, and in order to price the market at fair value in accordance with the known information factors. So let's take a look at the positive case. What may pull this market out and upwards first? So let's take a look at the different ranges. If we break, okay, and I think this is a tough scenario, because if we break upwards, we have to break the 8 EMA, we have to break the trend line, we have to break this 21, and we have to break the previous resistance. So the first level to look at is this 26.58, 26.60 level. Now, if we do get good news, we'll talk about what that news could be in a minute. If that goes forward, okay, we can, we have a lot of, shorts at this point in time. If there's a squeeze here and they start capitulating, we can definitely come up to this 27.43 level. Now, this 27.43 is a very key level because it's another confluence, right? It's a confluence of the 618 retracement from the December 2018 low to the present day high. And you can see here that it also presents a very good technical price resistance level. And then finally, if things really get going, I think the farthest we might see things reach in the next week would be this level here. Again, we have a confluence of 3 different factors, right? Number one, the 50% retracement. We have the price action, and we also have the 50 EMA. So if we do get above all these things, I think that would be the biggest target, for the week. Now let's talk about why that may happen. Well, number one is we have to look at the price of oil. So we're going to go here and look at the oil futures real quick. And you can see that the oil futures, that the market was, come on, let's go here. Oh, yeah, was really starting to hold, price up in this low teens, and especially this $20 level. This is key from the overall value area you can see here, for the month. And as you may be aware, Saudi Arabia and Russia are having a basically price war. Saudi Arabia is trying to, knock the U.S. shale producers out and Russia out in order to then become the overall, should we say, market driver and control price. And there's been some, let's say, positive news based on Trump, based on some potential meetings of OPEC next week that they may reduce the overall supply by about 10 million barrels a day, and it has resulted in this, in this rise in the price of oil. And where that's really key is that right now, when the price of oil is down at $20, we have a whole bunch of producers, especially in the shale piece, that are very, very overextended and have been financed, by different, bond and debt issuances, and they can't support that. Basically, they can't be profitable until they're at 40. But this is positive news, and it's kind of, should we say, stayed the overall drop. Remember we said when price got rejected earlier? Well, it didn't continue dropping. This is one of the reasons, because we had this little bit of support. So if we see, oil continue to increase on positive news and positive cooperation and formal meetings with OPEC Plus, next week, that'd be one of the triggers. The next trigger, of course, is the coronavirus. So let's take a look at what that may look like. So initially, let's come back here. And if you remember, we talked about last week that, on Friday, that we were at that kind of 120, 125,000 level. And you can see that we've basically, had a 75% increase, at about 300K. And of course, the death rate is proportionate with that, and that's very, very unfortunate. And you could also see that we still have this increasing, number of cases, throughout the world. We're now over 1 million at this juncture, and that's troubling. Now, the question becomes our social distancing and kind of quarantine functions, are they working? Is there an end in sight? Because the market always looks to discount news and information based upon 3, 4, 5, 6 months ahead. And if we take a look at, let's release this and go back to our other chart. You can see that the key countries that were really leading, this pandemic as far as the number of cases and the number of deaths, Spain and Italy, they're starting to level off. So the question becomes is that if you kind of extrapolate, and the U.S. is still here and behind, we have a larger population, and you could also say potentially we got a later start, is, we still may go here a little bit, which is bad news. But if we're expecting that the social distancing measures are working, is that we start leveling off, then the market can price that in, and it could be the overall catalyst to put us into that short squeeze. Okay, so that's the case for the upside. So now let's take a look a little bit about the case, for the downside. And the first thing we want to look at is the unemployment numbers, because these numbers and the people having employed therefore have disposable income, that accounts for about 69% of our GDP, basically the basis of our economy, right? We're a buy and spend economy. And what we noticed is the market really had, again, we've come to that market balance, even though we've had estimates kind of triple. Like beginning last Thursday, we thought there was going to be about a million new job claims for unemployment, and that actually skyrocketed to 3 million, and we didn't see a drop in the market. As a matter of fact, we saw an increase. Again, this Thursday, we projected about 3 million new jobless claims for unemployment, and it went to 6 million, and the market, really didn't dip. And then Friday, we had non-farm payrolls. The consensus was about 100,000, folks being unemployed, and it actually came out to 700,000. So basically a 6 of magnitude, increase. And the markets didn't jump, all that much, but they didn't decrease all that much either. And we'll take a look at that price action in more detail. But the bottom line is that the consensus numbers have been a lot lower than what the actual numbers have been, and we haven't seen that much of a move. And so the question is how long is that really going to last? And I really want to put these unemployment numbers in perspective. So I'm going to show you a really quick animated GIF to show you what unemployment claims look like. So as you can see here, we started way back in the Depression. We come up here to 2000. This is the tech boom. Right here is the overall 2007, 2009 financial crisis. And we're all the way up here, So we're talking about, between 13, 14, 15% unemployment levels potentially in the near future. And so that's going to be a question of how the market will factor that in, saying, okay, yes, we know we're going to hit that low, but you know what? We know that the coronavirus is leveling off, and therefore people will be going back to work soon. So that's kind of the push-pull I think the market is waiting for. Another case or another condition potentially that we might see the market go down is that we do have, if you remember, less downside. There's not as much support. And the first thing we want to look at is the overall advanced decline. Remember, we're looking at the New York Stock Exchange. It's a much broader index of the S&P 500. And you can see that even though we were kind of in a base, if you were in the S&P 500, right, we were in balance these last 3 days, right? We were in this range of about 120 points. You can see here that the advanced decline, was pushing lower, right? We had lower highs and lower lows for the whole trend, and we actually broke the support. That's one big key indicator. Another big key indicator, we'll go back to the charts here, and we'll go back to our daily chart, is we want to look at small caps, and we'll look at the small cap futures. This is the Russell. Oh, I'm sorry, I just typed here. And you can see that if we take a look at the Russell, and we don't have that consolidation, right? What we really have here is, if we look at these last 3 days where we had this nice balance, we basically have lower low and lower highs and a trend continuing downward. And small markets, definitely, they really do kind of lead the overall markets going forward. So that's another indicator potentially that we may break that support level on the S&P 500. Another key, should we say, factor from underlying what I call kind of the market internals on the broader sense is corporate bonds. Right, this is the ability for basically your S&P 500s and your triple Bs and everyone else to be able to issue credit in order to keep liquid. And you can see again we have the same type of basically lower lows and lower highs with with some decent support. So when we talk about going lower, we're not talking about a huge punch. I think that we're probably talking about something incremental. So overall, what does that mean? And I think that if we take a look at the weekly level on the S&P 500, we'll go back to the SPX. And I'll show it to you here on the daily first, and I'll show you how it corresponds to weekly. Is we should see, going down to about this 2,300 level. If we go lower, and I think that the probability is there because we don't have as many, should we say, resistance points, in that direction. But again, you never know how the market is going to react. But this is that first level, and then I'll show you that how it corresponds on the weekly. You can see here in the weekly, that 2,300 level, we have, again, very good price support. And if we broke this, basically this weekly's low, which would break the overall trend line from 2009, basically there's no support here till we get to that level. So if we go lower, that's the way we go. Okay, so now back to what we were talking about on our overall agenda. Let's go back to the PowerPoint for you, and let's talk about some longer term mounting pressures of why this may not be a V bottom, and even if we do see a retracement, why it may not be to the higher levels as has been in the past, in the February timeframe. So the first thing you have to look at is, who were the big buyers of the market? And that was basically corporate buybacks. And right now, based upon their cash flows, because they've lost so much in stock, they don't have the dollars to make those buybacks. In addition, the federal buyout clauses restrict and basically prohibit corporate buybacks as long as you're taking money from the government. So you can see here that the buybacks represented by this white line, were the primary driver, or one of the primary drivers, in overall stock purchase and stock purchase price. So if you take these buyers out of, you say, circulation, out of the equation, and we come back and say, this is all we have is our hedge funds, our public pension folks, our ETFs, the insurance companies, then you wouldn't expect to see as high as numbers, coming up. So also there's not this buying pressure in the markets. The next thing to look at is, even though we continue to focus, on the U.S., it's also to look at things contextually from the global perspective, and we want to look at that from what the emerging markets may be. And so the summary is that the emerging markets, right? That's the supply chains. That's manufacturing. With the coronavirus, they've really, should have been adversely affected. At the same time, a lot of these countries are also resource and commodity effective, kind of your precious metals and those type of things. And they've also, had, those markets are also down. So there's not a lot of ways for them to basically maintain their income streams, either by selling their natural resources or by serving as a manufacturing center. And if they can start defaulting on their bonds, that could be a huge issue. And right now, kind of an early warning signal, we've seen these massive capital outflows from those type of assets. A lot of people begin to say, okay, we'll have to, put a floor in, just like we're doing in the United States, right? We have this $2 trillion, support care package in order to, basically cushion the fall, if you will. But the question is that bailout big enough, even though the World Bank and the International Monetary Fund are contemplating about $1 trillion in relief? Well, the question is you have to look at the size of the overall debt of the emerging markets, and basically, it's at $72.5 trillion and increased 168% over the last decade because, well, why wouldn't you, right? You had cheap money and everyone was at the cheap money trough. That's just the way economics work. The key thing is, though, is that we have $5.5 trillion of that debt due, this year. And if you have $1 trillion, bailout, there's still a huge order of magnitude which is left there to basically start providing more pressure on the credit markets. And the key thing is who holds that debt? Not only should we say they're, national and sovereign type funds, i.e., let's just take Brazil for an example. Their central bank and their pension funds may hold some of that debt, but a lot of that debt is actually financed by the Western world, right, and the industrial nations, including the United States. So you can see now that this trigger of, if they start defaulting, it's very key to watch what happens and see whether or not, it triggers our defaults. And that's why we looked at, that HYG, the high yield, junk bond funds, to see whether or not there's pressure, and that'll be a continued thing to look at in the future. So if that happens, okay, if we start seeing these pressures on the market long term, and I'm talking like in the next 90 to 120 days, not the short term, where might the market go, and where might be some key areas to put on your watch list from an investment perspective to say, okay, this is a great spot to buy? Well, one of the things we take a look at is, again, using our old friends, the Fibonacci ratios. And if we jump back from all the way from 2009 and draw the fib, from the highs, right here, is this 50% retracement. Okay. Not only is that numerically, should we say, significant, okay, and it become a self-fulfilling prophecy, but the key thing is you can see that there is in this zone, if you will, this was an area before where we had a lot of imbalance, right? Consolidation. And this would definitely be one of the first points and the first consideration to buy in. So that's around the 2023 standpoint. Now, if things get worse, of course, then you can think that, you go all the way back to the 1701, and then then you'll be a key buyer. But for this point in time, I really hope we don't get there. And if things do tend to pull back, hopefully this 2000 level, not only being, like I said, statistically significant, support significant, but also big numbers significant, the area to really think about potentially reinvesting your cash that's sitting on the sidelines in your 401k. Okay, so now that's number 2 on the overall piece, and the last thing we want to look at is the day trading, right? These markets are very volatile, so the question is, how can we profit from them in the shorter term? And for those folks that are in that day trading mode or thinking about day trading mode, here's a little bit of a tutorial of some of the things that we're taking a look at. So let me go ahead and change screens for you here, and let me explain what we're looking at first of all. So basically we're looking at the S&P 500 futures. We're looking at a 1,000 tick chart, and a tick is basically every time that the bid or the ask is achieved, then that creates a tick on the chart, and it's basically a more of a volume based, if you will, or volatility based indicator of how price moves, right, based on that action. And over here we're taking a look at the 5-minute chart, and the key thing on the 5-minute chart is you can see here, this is the value area for the day. There's the top and here's the bottom. And these value areas are calculated based upon the overall volume of what has been the high and the low for that day, and represents the overall, should we say, where price has come to an agreement between buyers and sellers, and it's no longer a value when it gets to 24.73, and then people think that's a deal, and they think that it's basically oversold and undervalued, and they buy, and conversely it's overvalued and oversold at the 25.14 level. All right, so let's take a look at Friday's trading, and we're going to take a look back here, and we'll start based upon on the Friday close. We started here, and the overnight we started this huge drop, and potentially that drop was caused by 2 things. Number 1, we had non-farm payroll tomorrow, and people didn't want to hold. They were selling the market in anticipation of bad news. And of course, as you get toward the weekend and you have all this time, you have this uncertainty, and so maybe you want to start evening out your position in the market. But the key thing is that all of a sudden, we had this huge jump in the market. I mean, from 24.79 all the way up to 25.26. Basically, almost 100 points in a little bit over an hour. That's pretty incredible, and that was basically due to some of that oil news that President Trump was tweeting out, saying that he is trying to bring together the Saudis and the Russians in order to talk. So the first thing we did is we drew some fibs from this high to this low, and you can see that we got the 50%, the 6218, and the 781 on the retracement level. I'm looking at them to see where are some key support and resistance levels as price action manifests itself during the day. So as we start to move forward a little bit, I went a little too far forward, sorry about that. You can see here at 6:30, I'll make this a little bit bigger. At 6:30, where 6:29, 6:30. This is where the non-farm payroll information came out, and you can see what it did is it dropped right down to our 618 retracement level, and basically told me that the bottom is in. So here was the price consolidation, basically inside bar, working back and forth, and decided to basically in the pre-market with the S&P futures go long right here. Now, why did I go long here? Well, a number of things. Number 1, you can see I'm breaking the 50% support line. Number 2, I'll make this bigger, a little bit bigger, is that you have a cross of my momentum is crossing positive, my RSI is crossing positive, and my 13 EMA is breaking the 51. So now that I'm long, where's my stop? Well, my stop is right below the 50% retracement level. So I have a fixed support, and I have a pretty good kind of risk-reward ratio. Where's my target? Oh, my target is right here. Let me go ahead and pull this off, and you can see this. If my target is right here, you can see that this begins to approach this overall top of value level. So you take this and you run this up to top of value. You take your first profit here, and then I am going to make this bigger for you. And what I do is after the top of value, I work basically a 2-bar trailing stop. So here's 1, 2 bars, stop is here. 1, 2 bars, stop is here. 1, 2 bars, stop is here. 1, 2 bars, stop is still here. 1, 2 bars, okay, boom, okay. You know, I'm out about here on that trade. All right, so we keep moving forward. And what we want to look at is this concept of basically what I would call minor trends. So as the markets move forward, we get this big down pull, right? And we come down here. We got the big down pull. Here's our piece. We walk up. Okay, nothing here that I'm really playing. This is a pre-market piece. And then actually it comes here. So just when the market opens, you can see that we have consolidation. And I had a trade right here. Here's the consolidation, right? That consolidation also corresponds to the top of value. That's the top of value here on the 5-minute chart, right over here. And we're breaking that. So one of the key things I can see is that during this time, that price, I have a moving average positive stack. Here's my 50 EMA, here's my 21. Price is staying above both of those, and I have a stack, right? The lower moving average, the 21 EMA is above. Down here, on my momentum is staying positive. It's above 0. So once I crossed this, this top of value with a strong bar and waited for it to close, I went ahead and took this trade long, and basically my target was the previous night's high, right? So basically I sold and sold out right here. Okay, let's move forward. So we keep moving forward throughout the day. The market chops around. Chop forward. It came back down. It came back down into value. You can see that through here. I did not take any of this trade. And why didn't I take this trade? Because the previous times when we had unemployment reports at that point in time, we were bullish on both those days. And here we now exhibited again some bullish behavior. And so we waited. And so now it's saying, okay, potentially it's somewhat bearish. What I want you to notice is that we have what's known as basically a minor trend. And that minor trend occurs because we had this long pullback. And you can see right now we are chopping, right, with higher highs and higher lows. But in those higher highs and higher lows, we never broke this initial piece. So this becomes a minor trend in the longer trend. So we draw a support line. And that break has a number of key things for us. Number 1, okay, we broke the trend line. Number 2, we're breaking back into the top of value. Number 3, price, right? It's underneath the 50 EMA. Number 4, we have the moving average cross right here between the 13 EMA and the 50 EMA. And we begin to move down. Where's our target? Right here at the 50, right? So we set limits and boom, we're out. Did I miss all this? Absolutely. Do I care? Somewhat. Hey, but I went from 25.15, all the way down here to about, 25.04 or 03. Was able to catch a nice 10-point move. Now, remember this piece about the minor trends. Let's keep it moving forward. So let's move forward. We come down, and you can see that we had, again, this nice kind of pullback, right, in this piece. And we had this minor trend still staying below the 50% EMA, saying that we're somewhat bearish. So what do? We draw a trend line. Again, let's go through our checklist, right? Price is underneath the 50. The 21 is underneath. Our momentum is under 0. So boom, here we go. We're moving down. We're going to take first profit right here at the 78. And then we're going to kind of hold and we come all the way through to basically our trailing stop piece, and that would bring us right about to here. All right, again, trade 2. Let's move again. Let's move forward. If you come forward, so now we've hit 2 of these. Potentially there was another one here, but it was just happening so fast, and I've had my luck on 3 of these. I decided not to play it. And also, the other reason I didn't play it is that look at the time. The time here is 10 in the morning, which is noon New York time, and that's basically lunchtime. So again, let's take a look one more time. Right? We have this downward piece, and we have this trend. The trend is moving within that same range, never exceeds it. So that means we can draw a trend line here at the bottom. And we break. Now let's look at what we break. What do we have again? Same thing from our raw checklist, right? We have prices underneath the 50. We got a cross between the 13 and the 50 EMA. We got we basically came up here. We got a cross low, on momentum. First target, our fib level, right? We work our trailing stops. We kind of get out right around here. Okay, I think you guys kind of got the picture. I'll just kind of look at a couple things here for the rest of the day and show you that it does work in reverse as well. So this was basically, in my mind, this was all chop. I didn't see anything that looked good. Some people would say this was a double bottom. I didn't see a divergence here, even though there was a divergence from this point to this point. Potentially, you could have caught some of this. But basically, as we come up, we did have another trend line here again, right? Crossing. We crossed the overall 127. That serves as our entry point. Our stop is below the bar from crossing the 127. Well, we move up to here, and where does here come? Right to the bottom of value. See this on right here, 2472. Right here, 2472. I took profit here. Why did I take profit here? Because this is an overall bearish day, and I figured this was kind of just a liquidation break to the upside. Was there more on the table? Could I have stayed in? Potentially, but you know what? It just didn't make sense given the overall, should we say, trend of the market. And as you go forward, the one thing you can look at is, okay, all right, you had this, you could say you draw another trend line here, and you could have broke and taken this. I don't trade these last 15 minutes. This is just way too volatile. If you look from, this is at basically 145, to 150, you're moving 25 points in 5 minutes. To get in on a decent fill without too much slippage, it's just crazy. You never know what the market is going to do. So anyway, guys, that's all I have for you today. I hope that was helpful. Again, stay safe, stay sane, and we'll catch you on the flip side.